All right, now we are discussing examples of the factors which can result in increased audit risk. And specifically, we are discussing the factors which can affect the inherent risk. Now, we know inherent risk is the risk which is likely to occur in the client's financial statement due to its nature. And I've given you many examples of it. For example, an entity is offering the warranty, so there's a risk that they may not have recorded their warranty provision at all, or they have recorded the warranty provision at incorrect amounts. Now, this warranty provision risk is specific to this entity and will not be the case with the entity which is not offering the warranty. Similarly, when you talk about a construction company having long-term contracts, they will be having a risk in the revenue recognition. But when you talk about a retail store who is taking the money on spot from the customers, will not be having the risk of the revenue recognition. So the risk which are likely to occur in the client's financial statement due to its nature is known as the inherent risk. Another example may be, for example, an entity selling on the credit, they will be having a receivable balance in their financial statements. So if the allowance is not provided against those receivables, then the receivables may be overstated. Now, this receivable risk will not be the case with the company which is selling on the cash. So every entity will be having their own risk according to their nature. For example, a company selling food items which has a lax expiry, there's a risk that their food may get expired and still be part of the inventory. It should be written down. So if it is not written down, then the inventory is overstated. Now, this is not the case with the companies selling furniture, because the furniture is not going to get expired, although it can get obsolete. The designs and the models and articles may get obsolete, but still it will be having some value. It's not like the food item. If food item is expired, there's no value of it. So it depends on the nature of the entity, in which industry they are operating, how complex their operations are. So these are the factors which can affect, which can increase the inherent risk. The first point is changes in the industry it operates in. Now, that is a definite point. For example, I was operating in a food sector, and previously I was having the risk of food getting expired. Now I have moved towards the, let's assume, furniture business. Now, this risk of expiry has now been eliminated, and now there will be more risk associated with the furniture business. But with the change in the industry, the risk will also change. Similarly, the operations that are subject to a high degree of regulation, where you have to comply more. For example, you're operating in a manufacturing and industry, and you're manufacturing different things, and you are bound to follow certain environmental laws and regulations. So if you are affecting the environment by your activities, that means creating the environmental footprint. You have to create a provision for the loss, for provision for the impact you are creating to the environment to fix it. Now, this is not the case with the company which is not polluting or affecting the environment. So high degree of regulation can be anything. It can be in terms of labor, it can be in terms of data protection, it can be in terms of environment. So more regulation means more compliance, and there's a risk of non-compliance with the laws and regulations. And we are talking about the non-compliance which can affect the financial statements. Similarly, going concern and liquidity issues, including the loss of significant customers. Like, for example, if you are having a significant customer whom you are selling major portion of your inventory, and now they have contracted with another supplier, so your going concern may be affected. Now, I told you earlier that going concern is basically a business risk, that the entity may not able to continue its business in the foreseeable future. But it is also the audit risk when we talk about the basis of preparing the financial statements. If the entity is not a going concern, then the financial statement should be prepared on the breakup basis. And if it is a going concern, then going concern basis. So there is a risk that entity is not a going concern, but still the financial statements may be prepared on the going concern basis rather than breakup basis. Similarly, developing or offering new products and services, or moving into the new lines of business, and we know the risk associated with the development expenditure. We know that the risk associated entering into new lines, because you will stop using the old ones and now they are subject to the impairment. Expanding into new locations, application of the new accounting standards, all of them, when it is related to the financial statement, can be described as an inherent risk. So inherent risk will be increased if the entity is changing the industry, changing the products, new laws and regulations, stringent laws and regulations, new accounting standards, and things like that. So in the exam, the examiner may ask you, describe 4 factors which can result in an increased inherent risk. So you can choose any 4 and write over there. Okay, now we'll be talking about the factors which can affect the control risk. Now we know what is the control risk, that the entity's internal control system may not detect and prevent and correct the material misstatements. So when there are risks in the nature of the entity, first of all, it is being detected, prevented, and corrected by the entity's own internal control system. And if that internal control system is weak, there is no one to review that, there is no one to deal with that, then obviously the material misstatements will be directly transferred to the financial statements. So what are the factors which can result in an increased control risk? The first point is the lack of the personnel with the appropriate accounting and the financial reporting skills. Now we already know this point. Like for example, there's no financial controller, there's no finance director. If there is no financial, let's assume I'm the finance director of the company and I left the company and went to another company. Now the company is finding it difficult to hire my replacement, and till now there is no replacement. So my work, which I was doing, will be transferred to the other accounting staff. They may not be sufficiently qualified to deal with those financial reporting issues, and as a result, they may perform the incorrect accounting. Or for example, you can say this risk in another way as well. Let's assume the accounting is being performed by the other accounting staff, and there's no financial controller or the finance director who are actually reviewing the accounting performed by the junior staff. So if there is no one to review it, directly the financial accounting will be transformed to the financial statement, and maybe it is incorrect, then incorrect financial statements will be prepared. Similarly, changes in the key personnel, including the departure of the key management. Let's assume the entity was operating manually, and now the IT manager was hired to bring up the new accounting system. And when he brought the accounting system, he left and joined another company. Now they have the accounting system now, but there's no one to train them to how to deal with it. So if they are dealing with that accounting software themselves, maybe they are not aware how to do the accounting in that, and as a result, financial statements may be materially mistaken. Similarly, deficiencies in internal controls, which provides the opportunity for the errors and the frauds. Changes in the information ID environment. Let's assume you are having the previous system, and now your new system is brought and the data is being transferred from the old to the new system. The incorrect data may be transferred, the data may be lost. Installation of significant new IT system related to financial reporting. So these are the factors which is going to affect the increased control risk. Now, finally, we have the factors which can result in increased detection risk. Now, what is detection risk? Detection risk is the risk that the auditor's procedures were not able to detect the material misstatements. Now, for example, if the auditor is not doing the appropriate planning, incorrect, incompetent, inappropriate, junior staff is being used for the audit, less time is being spent on the audit client, no professional skepticism, that means being alert, questioning mind, investigative approach, sample size is not correct, sampling technique is not correct. Now, these are the factors which will increase the detection risk. So inadequate planning, inappropriate assignment of the personnel, that means the person who are not having the competence and the capabilities, no professional skepticism, not being alert to the conditions, not having investigative approach, inadequate supervision. When the work is performed by the junior or staff, there's no one to review their work, incorrect sampling techniques, incorrect sample sizes. These are the reasons which will result in an increased detection risk. So you have to learn it. All right, now we are discussing the audit risk equation. And we know that audit risk is equal to inherent risk into control risk into detection risk. Now, why there's a multiplicative sign between them? Why we cannot say inherent risk plus control risk plus detection risk? We cannot say plus because there's a multiplicative relationship. between these. Now, inherent risks are the risks likely to occur in the client's financial statement due to its nature. Let's assume there is no risk at all, although this is not possible, but let's assume for a while there's no risk in the nature of the entity. So if there's no risk in the nature of the entity, then even the controls are weak, even the auditor is not able to detect the material misstatement, still the audit risk will be zero because there are no risk in the financial statements at all. Everything is fine. Similarly, if there are risks within the nature of the entity which can be transformed into the financial statements, but the controls are very strong, control risk is zero. Every material misstatement is being detected by the control. Then even if the auditor is weak, still the audit risk will be zero. Now let's assume there are risks within the financial statements. Even the control system is weak, the control risk is there, but the auditor is so strong that every material misstatement is being detected by the auditor. Still the audit risk will be zero. So that is why we are having a multiplicative sign between them, that they have the multiplicative relationship. So we can say if the inherent and control risk, if the inherent and control risk is high, the detection risk should be kept low. If the inherent and the control risk is high, the detection risk should be kept low. We know that inherent risk is related to the nature of the entity. We cannot change the nature of the entity being an auditor. We cannot do anything related to that. Similarly, the controls are not related to us. They're related to the management. They have implemented the control systems. So these two risks are known as the financial statement risk. These two risks are known as the risk of material misstatement, and we cannot reduce these two risks. All we can do is if the inherent and control risk is high, that means there are risks in the nature of the entity, and even the control system is weak, then what we can do is we can reduce all risk, detection risk, by using more senior staff in the audit, by choosing the correct sample size, by being more skeptical throughout the audit, by doing detailed testing, by taking detailed understanding of the entity. So what we can only do is we can reduce the detection risk and nothing else. So remember this thing for the MCQs as well. If the inherent and the control risk is high, the detection risk should be kept low. All right, now we have ISA 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment. And we already know this. We started this chapter with this thing, that at the planning stage of the audit, the major activity the auditor is doing is taking the detailed understanding of the entity and thereby assessing the risk of the material mistake. Once we take the detailed understanding of the entity, we bring the financial reporting thing of that issue in our mind, and hence we identify the risk of the material mistake. For example, they are telling you that this year we have done research and development. Now, straight away it comes to your mind, okay, research should be expensed out, development should be capitalized. There's a risk that research may be capitalized if the development does not meet the criteria, but still capitalized. So when you are taking the detailed understanding of the entity, you will be understanding each and everything. There's a list of that coming up in the next slide, what we need to understand and how we need to understand. The slides are coming ahead. So ISA 315 is all about understanding the entity and thereby assessing the risk of material misstatement. So what it says, the auditor shall perform risk assessment procedures. Now, what are these risk assessment procedures? Coming up in the next slide. It's AEIO. Analytical procedures, inquiries, inspections, observations. So we are going to identify the risk by using these risk assessment procedures in order to provide a basis for the identification and assessment of the risk of material misstatement. Now, for example, you're auditing a telecommunication sector. Let's assume a mobile company, and You ask them how frequently you bring up the new models. And they said every 3 months, every quarter, we bring up the new model. And then you ask, okay, what about the previous one? They said we reduce the price of the previous one significantly so that the customers are attracted more towards the new one. Now, when they told you that they significantly reduced the price of the old models when the new models are in the market, now immediately the risk came to your mind that okay, the old models should be then written down to its NRV. If they are not written down to its NRV, then inventory may be overstated. So how you identified this risk? Through inquiries, by asking them. So this is how we are going to identify the risk of material mistake. We will be discussing that in detail in a while. The auditor is required to obtain an understanding of the entity and its environment, including the entity's internal control system. So we know that we are going to understand each and everything of the client, the industry in which they're operating, the related laws and regulations, their prices, their product list, their group structure, their financing structure, and their major customers, major suppliers, major shareholders. Each and everything will be giving us a different flavor and different angle for different direction for identifying and assessing the risk of the material mistake. The auditor shall identify and assess the risk of material misstatement, which is the financial statement risk, and determine whether any risk identified are, in auditor's judgment, significant risk. That means the principal audit risk. Like not every risk is the principal audit risk. The one which is in a capacity to significantly affect the financial statements. This is in order to provide a basis for designing and performing further audit procedures. Like the more risk we are having, the more testing we will be performing. And then ISA 330 then deals with the required responses to the assessed risk. We already discussed the responses. That responses are designed situation to situation. For example, there's a risk that allowance may not be recorded correctly. Then you need to discuss with the management the rationale behind the allowance they have recorded. What are the basis for the allowance? Say, for example, they have disposed of the asset and there's a risk that the asset may not be disposed of removed from the asset register. Then you need to check the asset register to confirm whether it has been removed. So response will be relevant to the risk. Now, these are the risk assessment procedures I was talking about. A, E, I, O. Analytical procedures, inquiries, inspections, and observation. Now, first of all, we'll be talking about the analytical procedures A. Now, remember this analytical procedures are used to detect unusual changes. These analytical procedures are used to detect unusual changes within the financial statements. Now, let me give you an example which is irrelevant to the audit, and then I'll be coming to the audit. Let's assume I'm your teacher and I am teaching you physically in the on-campus classes. And every day I'm having a very funny mood, and then I usually study the topics, and then we have fun as well. And then there was a day I was quite serious, and the students asked me, "Sir, everything fine? You're looking quite serious today, and your mood is not, I think, fine. Are you having a problem? Everything fine with your health?" Now, how he came to know that I am not fine today, whether I'm having any personal issue, any health issue, because he compared my general face expressions, my day-to-day face expression with the today's face expression. And then he came to know that today I'm not fine because my face was not as usual. Now, this is unusual change. Like now you talk about the financial statement. So sale. When the sale is increased, we see that there is the same increase in the cost of sales. This should be the general movement. But if the sale is increasing and the cost of sale is static, then there is a risk that the sales may be overstated. Now, this is an unusual change. The usual change is when the sale is increasing, the cost of sales should increase as well. Similarly, when the PPE, property, plant, and equipment is increasing, there should be an increase in the depreciation as well. So if the PPE is increasing and the depreciation is static, then this is an unusual change and there's a risk that depreciation may be understated. Similarly, if the loans are increasing, there should be an increase in the finance cost as well. This is the usual change, but the unusual change is that the loans are increasing, but the finance cost is static. So there is a risk that the finance cost may be understated. So how we will be identifying the risk? The first technique is by using analytical procedures, by looking at the unusual changes within the financial statements, which will be giving us the flavor that there is something wrong over here. And then inquiries, I've already given you the example. Let's assume you ask from the receivable ledger clerk, how was the recoveries this year from the receivables? And he said, sir, we are having a very problematic year and the receivables were not paying, and we were giving them the different settlement discounts and giving different offers so that they pay, but the recoveries were not fine this year. Now, when I asked him how their year was in relation to the recovery, they said not fine. Now, the allowance should be increased. If the allowance is not increased, then the receivables may be overstated. So I have identified the risk through the inquiry. Similarly, inspections. Now, let's assume you are looking at the aged receivable analysis, or let's take an example of inventory aged report or aged analysis, in which you have the information, okay, that this inventory is 30 days old, this inventory is 60 days old, this inventory is 90 days old, and similarly further. So the more older is the inventory, there are more chances the inventory won't be sold or sold at a very less price. So it should be either written down completely or written down to the NRV. So you were inspecting the inventory aged report and you saw that there is much of the old inventory present in this stock, and it is still being recorded at cost. If it is still being recorded at cost, then the inventory may be overstated. Now, this risk is being identified through inspection of the document. Which document it was? Inventory aged report. It can be anything. Similarly, observation, looking at the processes and procedures. Let's assume you saw that when the credit period is over, credit period is the days given to the receivable for the payment. When the credit period is over, they do not usually follow the receivable for even next 30 days or 60 days. Now, when you know that you're observing they're not following the receivables even after the credit period, then obviously the receivables might not pay, and if it is not being written off, then the receivables may be overstated. So you are using the risk assessment procedures, analytical procedures, inquiries, inspections, and observations to identify the risk of the material mistake. Now, there can be a lot of examples, but I've given you a few related to analytical procedures, inquiries, inspections, and observations. All right, now we have understanding the entity. What we need to understand, so there is a broad list of things given in these slides. Industry related laws and regulations and external factors. Similarly, the business operation, what are their products? What are their services, major customers, major suppliers, whether there are any joint ventures, any strategic alliances, whether they have any outsourcing thing, and whether they are selling through their retail stores, whether they are selling through the e-commerce or the both, and where are their outlets. And similarly, their investments, for example, if they bought the shares in another company, whether they have made an investments in the other companies, their capital structure, how much the equity is there, how much the debt is there, are there any transaction between the related parties that within the group. And similarly, the financial reporting thing, accounting policies, revenue recognition practices, inventories, foreign currency transactions, whether they are involved in that due to import and exports, whether they are buying the material from any foreign suppliers, things like that. Similarly, their recent financial performances, their key ratios, key performance indicators, their competitive analysis, all those things will be considered by the auditor in taking the deep understanding of the entity, because I told you that everything will be giving a different flavor. Okay, so why obtaining understanding of the entity? We have already discussed this thing, that we are taking the detailed understanding of the entity to identify the risk of the material misstatement. Once we have identified the risk of the material misstatement, we will be designing the responses. That means the auditor's action, the auditor's procedure to confirm that risk within the financial statements. And why we are designing the responses? To gather the evidence, because we have to support our opinion with some evidences. So this is the reason why obtaining understanding of the entity, to identify the risk of the material misstatement, and then further we need to design the responses to confirm the truthness and fairness of the financial statements, and to reduce the level of the audit risk, and then to set the scene for the opinion, because for the opinion we need to have something. We need to have something in the form of evidence to provide to the shareholders that, look, we are not giving any blind opinion. We have done the detail, and we have taken the detailed understanding of the entity. We identified the risk of the material misstatements. Then we gather the evidence on that. We design the responses and then gather the evidences. That is, then we are able to give you this opinion. So the shareholders will be having confidence that after the lot of work we have done, then we are able to give any opinion. Okay, so these are the responses to the assessed risk. Once audit risks have been identified, the auditors need to respond to those risks in an appropriate way, and we have already discussed that thing. Designing test of controls. Test of controls means the audit procedures to test the client system, and then substantive test, that means substantive procedure to test the figures and disclosures and amounts within the financial statements. Emphasizing the audit team to need to maintain professional skepticism, like wherever we are having the risk of the manipulation. I told you that you have to write the response. The auditor should remain skeptical throughout the audit. For example, the director's bonus is based on the profit. There's a risk that they may manipulate the profits in order to get more bonus. As a result, profits may be overstated. The response was, the auditor should remain skeptical throughout the audit to see whether the financial statements have been manipulated in this regard. Assigning more experienced staff, providing more supervision. This is how we are going to design the responses, and it can be either the test of control or substantive procedures, whatever it is. But we need to confirm that risk through the auditor's responses.